Welcome. My name is Sasha Moore, and we're here today at the Federal Budget Update webinar. Welcome. There are many questions about the budget's impact on individuals and businesses, such as whether the budget is stimulatory or neutral when it comes to inflation. And what does that mean for future rate cuts or even rises? We're here today with a panel of commercial finance specialists who will delve into the wins and losers from the budgets. And this panel is also going to provide some insights on the key priorities of the budget and what the government's trying to achieve, cost of living relief measures, an outlook for the housing market, business-focused initiatives such as tax updates and relief for mid-market businesses, and how the government's viewing deficits and where the economy is expected to move over the next few years. So without further ado, let me introduce you to our panel. We have Phil Quinlan from KPMG. Welcome, Phil.
Thank you. Thanks, Sasha.
We've got Matthew Port from Aquamore.
Sasha.
And Anthony Blondal from Equilibria Finance.
Good morning.
All right, so you three are in the hot seat, so we're about to get cracking. But what I would say to everyone who has kindly joined us this morning, this is going to be a very interactive panel event. The three panelists will be bouncing off each other, and we'd love any questions that you have, which will feed in either as it relates to the particular area or at the end. So be sure to use the chat function or the Q&A function, and we'll feed your panels into the members, your questions into the members. In addition, KPMG has developed a fantastic federal budget summary that reviews the budget's major implications, which we'll send to you along with CPD points post-webinar. So let's get started. Phil, let's just go back to basics for a moment. And can you give us a brief Budget 101 and just explain why it's so important?
Sure, thank you very much, Sasha. The first thing I'd say about talking about the budget, it's all based on future events. So there's no right answer and there's no wrong answer. A lot of it involves opinions. So I call out to Anthony and Matt here. Feel free to challenge me on any of my opinions that I throw out here. We'll see where we get to. Okay, so a bit of a Budget 101. What's it all about? Well, it's effectively the federal government giving an account of its revenues and expenditure over the next 4 years, how much it's going to collect from tax revenue and how it's going to spend this revenue. So there's some quite large buckets of unavoidable expenditure in there, being things such as social security and welfare, and that accounts for about a third of government expenditure, along with some other quite big spending buckets like health, defence, and also interest on government debt as well, which has been growing quite substantially over the last few years. So the budget's also about the government giving an account of its finances for the past financial year. And typically this is characterized by whether the government is generating a surplus or a deficit in its spending for the year. And surpluses are seen as a financial strength, and they're also seen as a government really being in control of its economy. So everybody, or ordinarily, people do look to those surpluses and look to champion those surpluses with them, but when they're there. So if we take a look back at the last few years, the COVID affected years, let's put it that way, we've seen some very large deficits in the government's budgets. And that's because the Australian government, like all of the governments around the globe, they've been very generous with stimulus measures. And that's really to be keeping the economy turning effectively. And the key reason why is that the government did not want a health crisis becoming a widespread financial crisis. And by and large, it was successful at achieving that with the measures that it implemented. However, if we look back to this budget and the previous budget, the deficits have now turned into surpluses. So this is the second year of a budget being in surplus, with a projected surplus of about $9 billion. Now, that's relatively modest surplus in the schemes of things, and it's really being driven by a couple of key things. The first thing that it's being driven by is really strong mining exports and strong commodity prices. So the government forecast that commodity prices would come off more than they actually, less than they actually have. So that's effectively a windfall gain. The other windfall gain is low unemployment. So that means that there's more people employed, there's more people paying tax. So effectively that contributes to the surplus. So that frames where we're up to. So deficits during the COVID years and then a couple of surpluses over the last couple of years. Why do economists, business and the general public follow the budget announcement so closely? Well, the answer to that really is that it shapes how the economy functions, from how much we have in our pocket as consumers to spend to how businesses invest in the future. So the measures that get announced really impact all of us, and they present businesses quite often with a range of opportunities. So when the government approaches a budget, it generally picks some key budget priorities and then comes up with a range of measures to keep the economy and economic growth on track. So as a kind of whirlwind 101, Sasha, that's kind of that's a budget in a nutshell.
Oh, perfectly said. And thank you for setting the stage on that. And it's a perfect segue also to throw out a double-barreled question, which Phil, I'll let you lead, and then I'm interested to hear Matt and Anthony's opinions. So what have been the key priorities in this budget, and what is the government trying to achieve?
Okay, I guess I'll get the ball rolling on this one and we'll see where we go. But we're going to be talking, I think, a lot about inflation during this webinar. And that's the biggest issue that the economy has been facing over the last 2 to 3 years. And it's really fighting the effects of quite strong inflation. And that's not unusual for Australia. A lot of developed countries have got the same issue. Inflation is effectively just a measure of how much prices are rising. So when we look at peak inflation, we probably peaked at about just shy of 8% inflation, annual inflation in December 22. And that's trended back to a more moderate sort of 3.5, 3.6 as at now. But effectively, the costs of goods and services is rising at a much higher rate than wages are rising. So effectively, that means for all of us, everything's becoming a lot more expensive. And then in turn, it makes it a little bit more circular because everyone starts looking for higher wages because things cost more. And that keeps on fueling that circle of demand. So when we look at the elements of that inflation, it's energy and rent, which are really driving it. And that's creating a very, very acute squeeze for quite a lot of households. So when the government been looking at the budget, cost of living relief is firmly really high on the agenda. What sorts of short-term measures can be introduced to households that really need it without stoking that inflation genie and making it self-perpetuate? So, looking at consumption, over 50% of our GDP is consumption. So that's what people are buying. And because things are getting more expensive and because rates are rising, that means that we're being forced to be a bit more selective in our spending, and we're also being forced to close our wallets somewhat. So we're seeing a slowing of the economy. So to try and get the budget back on track, the government's going to be trying to incentivize businesses to invest and grow in the long term. But equally, it's about finding that right balance in spending. Too much cash splash, as I think people seem to call it, risks fueling inflation and a blowout of debt, and too little might see the economy sort of start to contract. So that delicate balancing act, Matt and Anthony, I guess we're only going to find out in the next probably 6 months or two whether we're reaching the right mark or which direction we're going in.
Yeah, it is definitely a very fragile ecosystem. In terms of the relief measures that you mentioned briefly, can you just go into those?
Yeah, so the main one, which is no surprise, is the stage 3 tax cuts. So they're coming in from July. That's delivering an after-tax income boost for all taxpayers. So the way to look at that is everyone's getting an effective pay rise. So again, not new news, introduced, well, announced 5 years ago by a different government, the Scott Morrison government, and they were always projected to be introduced this year. So they were defined way before the inflation issues that we've been experiencing, and really they were defined to adjust to something called bracket creep. And that's really when, as incomes rise, because the tax rates aren't indexed, it means that more people then end up spending more of their income on tax. So effectively, you'd expect normally anyway that there would be some kind of periodic adjustment because the rates aren't indexed. So those tax cuts have actually been modified though. Now more of those tax cuts will be going to low and middle income earners as opposed to those earners in the higher brackets. And I think that there's no question that those kind of low and middle income earners are really experiencing most of the cost of paying. And it stands to reason that there's logic in passing more of those cuts onto those people. So what does it look like in terms of dollar terms? Someone on $50,000, they'll get just shy of a $1,000 tax cut. Someone on 90 grand, they'll get just shy of 2 grand. Someone on 160, they'll get 3.5 plus or minus. So the average benefit in everybody's pockets is worth about $1,800, and that's all 11 million taxpayers that are getting that benefit. So interesting though that it's not a lump sum payment amount, but it's going to be spread in equal proportions over the year as you get your pay. So that's kind of helpful in terms of avoiding an immediate spending splurge.
Okay, great. Thank you. We've had a question from Sam come in regarding when the new tax cuts will come into effect. And his question is, will the new tax cuts affect financial year 2024?
The answer is no. They come in from 1st of July, so it'll be 2025. So yeah. So no relief for your current tax return, but it'll be coming in your next tax return.
Okay, so in terms of inflation, and I agree, like that's really what the majority of conversation around budget has been. And I know, Anthony, you've got some opinions as well in terms of the budget being stimulatory or neutral when it comes to inflation, and the mismatch that potentially, just to further what Phil is saying with RBA forecasts and that delicate balance of spending versus savings. Can you provide some further insights in that?
Yeah, thanks, Sasha. Look, I guess to start with, just to reinforce Phil's points, is this is really a windfall surplus. There's no structural economic management in delivering a surplus here. The surplus really is on the back of bracket creep. $18 billion of revenue was due to bracket creep, and really all the tax cuts do is put that money back into people's pockets. High immigration, as well as essentially the resources sector. So this is a windfall budget. And then the government's announced $35 billion of new expenditure, which is through the tax cuts and through some of that relief we've talked about, which is moving to a $30 billion deficit next year. So there's no structural economic management in this surplus shifting to a deficit at all. In terms of the inflationary measures, the government's essentially trying to put money into the economy, and then it's arguing it'll decrease inflation at the same time, which is quite counterintuitive to what generally would happen in an economy. The government has forecast 3.5% inflationary growth. The RBA is at 3.8% for the June quarter. The government's forecasting underlying inflation to be 3% by the end of the year, which again is higher than the RBA forecast. And for 24-25, the government's essentially looking at inflation being at 2.75%. The RBA's projections are at 3.1%. So the RBA's job and their lever, the RBA's job is to bring inflation under control, and their lever is monetary policy. So what the government's potentially doing is adding pressure on the RBA around their decision making, and firstly, potentially prolonging interest rates at its current cash rate of 4.35%, or giving the RBA no choice if in fact the government measures are stimulatory, which there's a good chance they will be, with the cash, $35 billion being injected into the economy through these relief measures, giving the RBA no choice but to increase rates. So it's quite a political, arguably, sort of budget in terms of what they're delivering and some of that relief, but it potentially is making the RBA's job harder to, firstly, not increase rates, and secondly, to in fact decrease rates. I think the markets are now looking at possibly up to 1 or 2 increases. I don't think anyone's now forecasting any interest rate relief before the end of the year. Just a final comment: the RBA, the government's essentially hoping that employment growth slows and wages growth slows, but we've still got migration levels 50-year highs. We've had record migration over the last couple of years, and we've got the government now injecting money into the economy. So it's a pretty narrow path the RBA has to walk, and it's probably got a little bit narrower with the government's budget.
And what makes things, so just one point to add there, Anthony, just on inflation, what makes things quite interesting is the Treasury forecasting that sort of handing out the electricity credits will actually bring down inflation. There's everybody will be getting a $300 energy rebate this year. So it doesn't matter if you own 2 homes or your beach house at Palm Beach or wherever it might be, you're going to be getting $300 to help with the cost of living of your power bill. Whether you have any struggles with your power bill, that remains to be seen in your second home. But the way that that's going to get applied is that effectively it will be all of the power companies will effectively have a $300 sort of credit, so they'll reduce the bill. So as a consumer, your bill will be less.
And there's no means testing around that. It's available to everyone.
Yeah,
that's
and
right.
then when you look at the inflation basket, well, your energy costs have been less on a temporary basis because your bill's been less because that credit.
Yeah, and essentially Treasury's forecast effectively takes those energy and rental relief subsidies into account, which is a sort of masking what's really going on from an inflationary perspective.
Well, the other big elephant in the room, in addition to inflation, is obviously rate. So which you've touched on, Anthony. Matt, I'll go to you next. What does this mean for future rate cuts or even rises in addition to what we've just discussed? And I'll hit you with a double barrel. We've had a question from Raj come in. What's the expectation on interest rates by the end of 24 and 25? So I know we've touched on that a little bit with Anthony's sentiment. What are your thoughts?
It's a really interesting budget, as Anthony and Phil alluded on there with, we have got the circulatory pressures with, everything's more expensive, wages haven't increased, but people are looking for more out of their pay packet, and that's moving a lot of people around. With the overseas migration, as Anthony said, it was out of control over the last couple of years, and the government are looking to bring that down significantly, which in part of the budget you'll see that there's no real relief for backpackers and people on consultancy incomes and all that sort of stuff. The budget, in my opinion, does mask the inflationary pressures that are going to happen as a result of the fiscal policy that they've put in place. And Anthony made a really good point that, the fiscal policy that they've put in place has put a lot of pressure on the RBA with their next monetary policy move. The government are being the good guy here, giving everyone a tax cut and doing all of this sort of stuff and helping out with all that stimulus. But the RBA is going to be the bad guy, and in my opinion, rates aren't going to come down. They don't have any scope to come down. They've done really, really well in reducing inflation from, as you said, Phil, it was around about 8% at peak levels December a couple of years ago, to 3 and a bit now. The target inflationary rate is somewhere between 2 and 3%, if I'm not wrong, and I don't think that's changed. And the extra money that this budget has put in place, that's going to alleviate to it. And you'll see many analysts in the market, very scathing of the budget that was put out there, because of the inflationary pressures that we've got. There has been a blowout between underlying cash deficit and total headline deficit as well, and a lot of that is under the table spending on, you know, infrastructure projects or investment vehicles that go into stuff that's not really spoken about that much, but that will add to inflationary pressures. So to answer your question, I don't think there's going to be any downward movement whatsoever. I think they'll need to sit it out for the next 5 to 6 months, and there could possibly be an increase at some point towards the end of the year.
The only thing I'd add to that, that Matt's mentioned, is what the RBA is fundamentally concerned about, and you would have seen the shift in their language over the last couple of meetings, is inflation becoming entrenched.
Yeah.
And a lot of the inflation now is domestically driven. It's not coming from supply chain issues overseas. It's not coming from the war in Ukraine or whatever. It's now very much domestically driven, and what they're concerned about is inflation becoming entrenched in the economy, where it stays at essentially the level it is now, and it's driven by the domestic economy, as distinct from
sticky.
overseas
Yeah.
things.
Yeah.
So the RBA is, they might be reluctant to increase rates, but ultimately they may have no choice. So I don't think we're going to see a rate cut, to answer Raj's question, this calendar year. If there's probably more likelihood of a rate increase, with potentially some of the inflationary pressures flowing through, with the employment numbers where they're at, with consumption where it's at. So I think we've got to be circumspect about interest rates. Our cash rate's still lower than a lot of international rates, the US, the UK, Canada, New Zealand. So I think there's more chance probably this calendar year we'll see a rate rise than a rate decrease, and that's probably strengthened after the budget.
Yep, 100%.
So now actually, sorry, Phil, go ahead.
Yeah, I was just going to say, do you think one of the big issues is going to be how much households spend or save the tax cuts that are coming? Do you think that's going to be a key determinant?
It depends on what everybody does with that money, right? You know, the current account balance across Australia was one of the record highs in the world before the pandemic. Australians are very good at saving money. They're very good at keeping it, and a lot of people dipped into their offset accounts. They dipped into those savings accounts, and that savings surplus really got drained during COVID. Even the government helped out with the superannuation. Remember, you got $10,000 out of your super 2 years in a row, and I think the uptake on that was about 85-86%. So I guess it comes down to what people are going to do with that saving. Are they going to keep it, or are they going to spend it? And if they spend it, then we get stuck back into that circular motion that Phil, you were talking about, where people are spending but prices are still going up and wages aren't going, and it's that circular motion that you can't get out of.
Indeed. Now's actually possibly a good time to go to Chaluka's question, which is exactly about what we're talking about right now. So the statement is, if the cost of living is going up, population is compelled to pay higher amounts for living expenses. Therefore, consumer spending is high, and to curb that, the Reserve Bank increases rate. If this is correct, isn't it a vicious cycle, and how do we come out of it?
Yes, it's exactly that.
It's a question on everyone's lips, right?
Yeah, and I mean, I guess the RBA's only lever, as Anthony pointed out, is their monetary policy with interest rates, and it's a blunt hammer for a very complex problem, and all they can do is wield the hammer, and that's all they can do. And if rates go up, people spend more on their mortgage. That means they cut back on. It'll start with non-discretionary consumer goods, for example, and then people have to make cuts elsewhere. And what they try and get people to do is to stop spending money on certain things, which will then cool the prices. So it's a hard ask for people to tighten their belts. But I guess that's what the RBA want people to do, is to stop spending money in certain places to help bring prices down.
And I think probably the other sort of areas are some of the other things that are driving the employment market, that are keeping the employment market tight, driving the housing market, is the record migration numbers obviously coming in, which is providing stimulus to the economy. And for example, the housing market's had now 15 months of consecutive growth, essentially because of a supply and demand mismatch, which is driving up the cost of houses, which is having vacancy rates at record low levels, driving up rent. So one of the biggest inflationary pressures at the moment is rental pressure. The government talked about bringing everyone's electricity prices down by $275. The cost of power's being driven up by their policies in and around some of the renewable policies. So I think there's government responsibility around expenditure and management of the economy, management of the migration reinflows, as well as management of government expenses. The RBA's lever is interest rates, and at this stage, whilst inflation's coming down, it's certainly not under control, and it's a narrow path to be walking. Essentially, to bring those numbers down and slow the economy, unemployment would go up, household expenditure would go down, and both those things are outside of the RBA's range at the moment in terms of where they're trying to get things to, and the risk is maybe some of the government policies are counter to achieving that goal.
Yeah, and I mean the budget returned such a strong surplus because of higher income tax receipts, because of low unemployment. So it's really interesting, isn't it?
But I guess when you do look at the inflation numbers, we have made some good headway in getting down from the 7.8 highs to the where we're up to now. So that's an encouraging trajectory.
Indeed.
Yeah.
Well, we might actually just go to some further Q&As or comments actually. So Paul's mentioned that NAB yesterday published that around 60% of people surveyed would either save or repay the tax reduction, and a further 15 or so said that they would spend it on essential goods and services. So it appears that the market is quite conservative at the moment and quite cautious of spending. So Anthony, I will go back to you in terms of, let's go to the housing piece. So the rent and mortgage costs are really fueling the cost of living crisis with a severe supply-demand imbalance for housing. Is there anything in the budget that addresses this?
Yeah, that's I guess the backdrop is that Australia's in a chronic housing shortage that's probably been building over the last 10, 15, 20 years. The government committed to try to build 1.2 million homes over the 5-year period. 136,000 dwellings were approved last year. 5,000 homes from that scheme have actually been built as a comment. We got record migratory numbers, which is adding pressure onto the rental market as well as supply. So as we touched on, we've seen 15 consecutive months now of housing market growth. It's grown another 8.7% over the last 12 months. So we're back above nationally the sort of the peak of those prices in a pandemic. The budget essentially focused on three things. It focused on trying to increase supply through some of its initiatives. It focused on rental relief, and it also focused on construction by trying to provide some incentives around apprenticeships. There's not a lot of new announcements in that. They're actually building on a lot of existing announcements in and around some of the supply side initiatives. So the budget focus was essentially a $6.2 billion package, looking at social housing, providing social housing, looking at helping incentivize some of the infrastructure projects, looking at the rental relief, which Phil touched on, and also looking at apprenticeship programs to fast track essentially labour for the construction industry. But 1.2, so it's a very much a supply side budget in terms of housing. A lot of the money that was announced was already, a lot of it was building on previous announcements. There was no sort of demand side, I guess, for want of a better word, initiatives, for example, assistance for first home buyers, other than the existing programs. I think the main challenge is the sheer volumes of houses and units that need to be built. If we look at and the challenges that come with providing that for the developers in terms of building build to rent projects and the barriers from different levels of government to actually being able to construct those programs. So the pipeline is not reflective of what needs to be built. There's some saying that to actually keep up with the supply and demand mismatch, we need to be building about 300,000 homes a year. As I touched on, 136,000 were approved last year. So we're well and truly short of those numbers, and there's no silver bullet to this problem in terms of that supply and demand mismatch. So what that's creating is concentration, competition around the availability of housing and units, which is keeping prices strong. Regional growth's remaining strong because people are facing affordability issues in the major cities. So they're looking at the regions that are commutable. The regions have been growing in and around 6 to 7% as well. So across the board, it's mainly driven at the moment by Perth, Brisbane, Adelaide, but essentially nationally we got vacancy rates, some below 1%, some in and around 1 to 1.5%, and we've got another 15 consecutive months of growth in the housing market on the back of a massive supply and demand mismatch, which the government's tried to address through the budget with its programs, but how well that will actually be delivered and actually be able to be implemented is where the rubber's going to hit the road in terms of that, and whether they can actually physically build what is needed.
I think, Anthony, the inflationary environment over the last few years has been quite challenging for the building and construction sector, juggling things such as labour shortages, material shortages through COVID, weather delays as well can have an impact. They've all been placing pressure on margins, so it can be quite a challenging area. That building and construction segment can be quite challenging because of those variables. And if we look at some of the statistics, the cost of building a home's increased by, say, 40% since pre-COVID. And then you've got the rising cost of land, etc. So making for a very, very, very much more challenging place in the building and construction sector.
Yeah, that's true. And on the back of that, we've actually seen some builders go out of business essentially because they've got contracts in place that they can't deliver on. A lot of companies, as we all know as brokers, a lot of them are reluctant now to do a fixed price building contract, or have been reluctant for those reasons you've talked about. Sorry, Matt.
No, I was just saying it was interesting you were discussing the government looking to build houses closer to people's homes. And I think that was part of the Future Made in Australia pledge that came out of all of this, was that they were looking to have designated spaces for people to build houses that are closer to their work, to avoid longer commutes and things like that. That used to, especially in Sydney, it was the debt-driven rat race where the closer you lived to the city, the easier it was to get to work, and the more time you had in your day and the better work-life balance you had, but you had to pay for that. And I think they're trying to pull that away now with, you've got Badgerys Creek, and you've got, for those of you that are not familiar with Sydney, the western sort of suburbs, where they're trying to build more offices and houses closer to Parramatta and all that sort of stuff, where they're trying to get that work balance life back to people and make everybody a little happier with that sort of stuff.
Thank you all for your comments. Staying on the housing market, Anthony, I'll go back to you. In terms of the outlook for the housing market, I know that you've talked about states which are flourishing at the moment. what's your perception for the next sort of 2024, 2025?
Yeah, it's the market from a credit perspective. The market's, I think we're coming into a little bit of a subdued patch because of a little bit of uncertainty around interest rates, affordability. We're seeing an uplift in investors. Investor growth's up, investor credit's up 20-30% over the last 12 months. We're seeing a bit of a trend of potentially first home buyers who are unable to purchase a home looking at an investment property to get in. So the investor market is changing a little bit from long-term investors who are looking at the capital growth and managing their cash flow to the uplift in rent investors from a lot of millennials and that generation who are more looking at getting in the market than potentially buying a property that they're able to live in down the track. But we're coming into, I believe, a little bit of a subdued market. But what keeps the market moving is the supply and demand mismatch. I think we're going to keep having concentration competition. I think the market's going to remain resilient and strong. Listings remaining fairly strong. And I know that what we're seeing is most people who are looking for credit understand what they can afford, what they can borrow, and are in the market to buy. So I think the market's going to remain strong, albeit we might come into a little bit of a subdued patch with a bit of uncertainty around. There's a shift in language now about interest rates, obviously, which we've talked about. There's a little bit more uncertainty around cost of living pressures and inflationary pressures. So we might just see a little bit of a slowdown over the next 6, 7, 8 months. But I think the fundamentals of the market is that supply and demand has a big mismatch. That's not suddenly going to change. And we are seeing a bit of a shift in activity to the investor market, coming back in, accessing equity, or to those who can't afford to buy a home, looking at buying an investment. Big challenge in the housing market is those looking to upgrade from, say, a unit to a house. For example, the median house price in Sydney is now 1.6 million. A unit price is 800,000. So for those younger families trying to upgrade to a house, it's a massive challenge. And that's not going anywhere. So there's some challenges for those sort of buyers to find the opportunities to get into the market. We're still seeing the bank of mum and dad coming into play to help those sort of things. The deposit and affordability challenges for first home buyers isn't going anywhere. So it's a difficult market for those trying to get into it. And the shortage of supply doesn't make it any easier because it keeps the prices staying strong. But we might see a little bit more subdued over the next 6, 7 months with people maybe waiting to see what does actually happen with inflation and interest rates.
Thanks, Anthony. Matt or Phil, do you have any further comments?
I guess kind of Anthony had already put it, this is a long-term supply demand imbalance, and I guess it doesn't look like it's going to right itself in the near term. So it will always be more demand than supply at least in the immediate term.
Mm-hmm.
Yeah, it's going to be a hard issue to solve. I think in the budget there has been I think there's around about 4.5 billion of new housing expenditure for developers, giving money to the state governments to help build new homes. I think it's around about 2 billion for extra concessional financing for providers and charities to help social and affordable housing. I also think there's visas that are being fast-tracked for some migrants to come and work in housing construction to try and help the supply and demand issues that we are facing. But it is interesting to note that the visas will be fast-tracked for that sector when net migration is coming down significantly. So there's quite a few things to balance up.
Yes, indeed. We might go to a comment and a question that Tanya's had. She said, talking to a few developers, they're finding it hard to make a profit on housing development. Some have losses. So there's very little incentive to build houses. This problem is widespread, and the majority of developers are struggling to make a profit. Talking to the federal member in Queensland a few weeks ago, he said that a part of the solution would be to reduce the government fees. Is there anything in the budget to help incentivise developers?
Just before we answer that, the AV Jennings CEO said, which is building on that point, that about 200,000 of the cost of a new home is tied up in fees and charges across all 3 levels of government, and it takes about 7 years for a developer to see a return on their investment. So that was a comment made after the budget, just as a comment to add on that question.
Yeah. Yeah, I
So
mean, as I said earlier, I think it's around 4.5 billion that's somewhere in the budget for new housing expenditure. I think a lot of that again is based on low income housing, and I think the NT, or it might be Northern Territory or South Australia, has been given around about 840 million for housing in more remote or regional areas, to try and incentivize developers to look at these sorts of places and get that sort of thing done. I think you can still get a relatively good yield as an investor in these regional places, but as the comment said, it's hard to get developers to make a profit considering how much tax or fees are in there on each build. So it's an interesting dilemma.
I think also, Matt, that taken with planning approvals as well. I don't know, Matt or Anthony, if you've got any comments on sort of the complexities of planning rules and how that folds into kind of property development.
Well, in terms of financing, we get a lot of clients that say, yeah, look, we only need a loan for 18 months, 2 years. The DA will be here, it'll be good to go. That 2 years elapses, and they're only halfway through the DA stage, and they've done everything right. They've sent us all the correspondence. The delay is certainly with the council, and I think there needs to be some real course of action taken to speed that up, whether it's investment in more employees or however it is. But I've seen something very interesting that, I don't know if this is true, but apparently a snail can get from here to Canberra and back quicker than some of these DA approvals. Again, I don't know who measured this, but some of these DA approvals, I'll need to find the article and send it to you guys, but some of these DA approvals get done. It's staggering.
And I think that's the challenge. While the government's announced a lot of initiatives around delivery of social and affordable housing, they haven't really addressed some of the challenges developers are facing in terms of the issues of planning, the issues of getting greenfield sites ready and stuff like that. And that remains a big challenge in terms of the development pipeline. Is actually, I mean, developers are putting 4, 5, 6 years aside to get DAs through, and then they got 15, 16 different taxes and planning submissions and stuff like that. So it is a challenge that hasn't really been addressed. In fact, just a final comment on that, the National Construction Code is going to add another 30 or 40 grand to development costs. It's just been announced, which is just counterintuitive to what they're trying to do, which is open up supply. I think the Victorian government's now starting to add some incentives for investment in the build to rent programs. So that's just a state government.
Thank you. It's definitely multidimensional and complex. Moving and segueing from housing for a moment and moving on to business-focused initiatives. Phil, I'll go back to you. What's in there for mid-market business from the recent budget?
I guess overall, not really a huge amount of specific measures for sort of small and medium-sized businesses. The one thing that is in there is just the extension of the instant asset write-off scheme, and that's for businesses with a turnover of less than $10 million. So that is in existence. It will be extended till July 25. So eligible assets costing less than $20,000 can be deducted immediately in the tax year that they're bought. So that's good news. It'll help small businesses boost their cash flow and help them benefit from making investment in their businesses. Another smaller boost is along with household, some small businesses will also get an energy credit of up to $325. So it's probably quite minor in the scheme of things, but probably very welcome by small business nonetheless. I guess the biggest impact for mid-market businesses is probably a bit of an indirect benefit. Most of those smaller businesses are reliant on consumer spending. So any slowdown in consumer spending can have a disproportionate impact on smaller businesses, particularly those in the hospitality, retail, and trade. So they can find it harder to compete with larger businesses when competition gets a bit tighter. So, and again, some of those businesses were quite impacted during COVID, and some of them still do have some COVID accrued debts that they're still sort of carrying and managing as well. So those stage 3 tax cuts and the electricity rebates effectively putting money into the hands of households, and indirectly small and medium-sized businesses may benefit from that because of the spending. So I think overall there are a few things, but sort of my take on it, and I welcome Matt and Anthony's views. I don't think there's anything landmark in there for sort of mid-sized businesses specifically.
Yeah,
I think the mid-market stuff, there's not a hell of a lot. The green businesses are obviously going to do really well out of this with this future made in Australia stuff, trying to get Australia into renewable energy superpower with $20-25 billion in there. But that's more for big business. Yes, there might be a bit of an onflow into the mid and small, the sort of feeder businesses that can assist with that sort of stuff. And for me, it's really interesting given that the surplus was returned on higher commodity prices. We're still pulling stuff out of the ground. We're still selling coal, we're still selling oil, we're still selling gas. The lucky country is still doing really well in that respect. And it was very interesting to see how much money Australia is trying to put into green business, especially with the battery and solar panel makers. That for me is where the big businesses might get a win out of it. And it'll be interesting to see how some of these larger businesses can try and take advantage of the green stuff that's coming out of it.
Anthony?
Yeah, I don't really have a lot to add to that. I mean, I think really for small businesses, there's the continuation of the instant asset write-off. There's the small energy relief, and then as Matt touched on, there's the broader piece in and around the Future Made in Australia program that is trying to promote the manufacturing and the renewables sector. So yeah, there's no sort of relief for small business in terms of doing business, in terms of the red tape, in terms of any initiatives around that. It's fairly there wasn't a lot of focus on that in terms of new initiatives.
No, fair enough. Well, let's maybe now segue into who are the real winners from this budget. So Phil, who would you surmise as sort of the main winners in this situation?
Main winners, I guess, the stage 3 tax cut. So that's effectively giving all taxpayers some immediate relief. So I guess that's a wide range of winners there. Again, that's not new news because it's already been announced. The $300 energy relief, again, that's quite broad. That's all houses. So I guess that's probably something of a bonus that sort of households probably weren't expecting. Workers in the childcare sector, I think they fall in the bucket of being winners. There's a projected uplift in their wages, and that's going to be confirmed by a Fair Work Commission report when it releases its review. we've touched on low income renters. We're going to see more rent assistance support for low income renters. So that's going to be good news for about 1 million Australian households. And again, the clean energy, so companies involved in decarbonisation and production of green energy. And that's across research and innovation to manufacturing, and giving a real incentive to invest in green business. Superannuation, parental leave, the superannuation will be paid on paid parental leave. So that's good news in addressing the gender gap and the superannuation gap. Then we've got something for students as well. So there's the HECS loan structure will be amended. So the interest component will be amended. So that's going to remove about $3 billion in outstanding HECS loans. So that equates to an average saving about $1,200 a student, so anyone with student debt. So again, that's good news and good support for people who need it most. On the losers side, I think that sort of we've universities are going to be subject to a cap on incoming international student numbers. So they're either going to have to, and it's a bit opaque as to how that cap is going to work at this stage. I think there'll be more detail on that coming. But so that they'll be faced with a choice of having to either curb their international student numbers or invest quite heavily in accommodation to house the increased numbers of overseas students. Matt touched on it. We're going to see a reduction in migrant workers. So there's going to be a cap for permanent migration. That's going to be capped at 185,000 people. So net overseas migration is probably going to halve from about current levels. So anyone looking to relocate to Australia may find it a bit harder. So they may be a loser from the budget. So I guess overall, there's probably more winners than there are losers in that list. So that's an encouraging sign.
Indeed. Matt or Anthony, do you have anything to add?
I think the biggest loser is the RBA. All this money that's getting thrown in, and they're tasked with being the bad guy to keep inflation down. They are going to have a difficult job, and it'll be on them to, as I said earlier, to hit this very complex problem with a large mallet. To be fair, I think the federal government are spending less on consultants, labour hire, and contractors. We see a little bit of that in our space, in the small business space, with many people being freelance contractors, getting money paid into their account as a contractor as opposed to a paid employee. So a lot of those government contractors will be getting shed. I think they're spending a little less on defence consultants, which is strange given that there's a lot of investment vehicles. There's obviously the submarines that are getting spent a lot of money on. So who's in charge of these projects, we don't know, given that defence consultancy is getting reduced. So
I don't really have anything to add. I think that covers it. I agree with Matt's point, essentially, that it's creating more pressure on the RBA and its decision making. So yeah, I think that's covered it all well.
Fantastic. Well, Anthony, staying with you, and just to wrap, I'm interested in all of your perspectives on this. So what are your indications of where you see the government really moving the economy over the next few years?
Look, I think it's a tough question because I don't think the government knows, if I'm blunt. I think they're hoping that their spending initiatives don't fuel inflation. I think they've created a lot of these problems through record migration that you could debate they're not taking responsibility for. So I don't think they really this surplus was on the back of resources, bracket creep, and migration. There's no structural reform. There's no economic management or plan. The budget should have been about restricting inflation, productivity, and government spending. And there was none of that. So I don't believe the government really has a plan for where they see the economy going. They're hoping that their $35 billion of expenditure decreases inflation and increases unemployment and slows wages to bring inflation under control. And that is not, that's counterintuitive to economics. And it also doesn't really set in place a framework for the economy going forward. A lot of the problems that we're facing have been created by the record migration, the lack of addressing some of the structural issues in the economy. $18 billion of the surplus was due to bracket creep, not economic management. So I think, if I'm frank, I don't think the government's really got a plan for the next 2 or 3 years. We're swinging to a $30 billion deficit, which is essentially going from $9.3 billion now. They're spending $35 billion. There's your $30 billion deficit next year. So there's no structural economic agenda around managing the budget at the moment.
Yeah, there's a lot of hidden spending. I think it's around about $80 billion in what they're going to call under the radar spending, stuff that you don't really see. And that touches on the point I made earlier about the difference between the underlying cash deficit and the total headline deficit. I think they only started using the total headline deficit a few years ago, which is really interesting. So, yeah, I think we just need to wait and see what happens. And as I said, I found it very interesting, all the money they're trying to put into the green and clean energy initiatives, which on paper is absolutely brilliant. And that's the way that we need to go as not just as a country, but as society, as a world, as people. We need to think about sustainability and all the rest of it. But the very large majority of the budget came from, again, as I said earlier, us pulling stuff out of the ground and selling it to China. So what do you do, right?
Selling it to China, then buying it back at a higher price.
Yeah, we could sit here for the next hour and a half and talk about that. Yeah.
And I think sort of the final word from me, Sasha, is look at it. It's a delicate balancing act. It's about kind of providing support to those that need it and some kind of relief, and also still wanting businesses to invest in future growth as well. So it's a challenging situation about trying to get the balance right.
No, indeed. Well, I think that's the perfect place to wrap. We don't have any crystal balls, but we all definitely do acknowledge that it is a complex and fragile ecosystem. So thank you so much to our fantastic panel for their insights today. Phil, always great to speak with you. Anthony, thank you for your insights.
Thanks very much, Sasha.
And Matt, for your contributions.
Thanks.
Again, thank you so much for tuning in. We will be sure to send a copy of this webinar. And again, as I mentioned earlier, the KPMG summary. Thanks again, and we will look forward to seeing you next time.